A great way to increase wealth is through investing. As a result, you can focus on the things that matter most to you while your money earns interest for you in the background. Consider how incredible it would be if you could take your ideal family vacation and still come out ahead financially. Okay, well, that's not impossible by any means in the world of investing. But only a small number of investors have the necessary knowledge to succeed. And that's why we made this video. We will share each and every investor needs to be aware of these 7 psychological tactics. Number 1. Only risk money you can afford to lose. The first thing that every investor should understand is that investing involves risk, which simply means that you cannot predict the outcome of an investment. Each investor receives a return proportional to the level of risk they are willing to take. In other words, every investor understands that there is no guarantee that they will get their money back. As a result, the first psychological tactic you must master as an investor is to never take a risk you cannot afford to lose. Moreover, you must understand that investing is not a method for becoming wealthy quickly. Patience is one of the most important qualities to have as an investor. When you've invested more than you can afford to lose, it can be difficult to be patient. That's when investors start freaking out quickly after getting into a trade because they thought they'd be making a killing right away. Warren Buffett believes, if you don't plan on holding stock for 10 years, don't even consider holding it for 10 minutes. That is, you won't double your money overnight, so don't invest more than you can afford to lose. When you invest more than you can afford to lose, you are more likely to make poor investment decisions. Make a list of the top 5 concerns you have right now, and I'm sure some of them involve money, because money is more inextricably linked to our emotions than most of us realize. When you invest more than you can afford to lose, you are more likely to become concerned and make poor decisions. For example, if all you have is $10,000 and you decide to invest it, you may wake up the next morning to find the market is down 10% and your investment is now worth $9,000. What would you do in this situation? Because this is all you have, you will most likely panic and sell your holdings to avoid further losses. Real investors, on the other hand, understand that dips are part of investing, as we'll discuss later in this video. So make sure to keep watching until the end. The second tactic: start by taking small steps. As a new investor, you're ready to give it your all after watching an inspiring video like this one, or reading a blog about investing. However, you must follow the advice of every successful investor and begin with small steps. If you are not completely knowledgeable about investing, it's okay, because every expert today was once a beginner. You need to be willing to dream big. Invest little at first and learn as you go. Consider today's world's fastest man. Can you believe if he won that title when he was only 2 years old? I also doubt he could have won the championship when he was 10 years old. With the consistent practice, he improved. And when the time was right, he appeared before the world to claim the title of world's fastest man. Similarly, the same applies to investing. You don't become the best investor on your first day. You improve over time by understanding the fundamentals of investing. Most large businesses today began as small branches, and the most large investors today began by taking baby steps. As a result, you should begin by investing a small amount of money in various sectors. At this point, you shouldn't worry about making a profit, but rather gaining as much knowledge as possible. Due to a lack of fundamental knowledge, the majority of new investors lose money. You can, however, learn how to invest profitably by starting small. By gaining an understanding of the various industries, you will minimize your risk. Remember that one of the reasons why successful investors only invest in what they understand is because of this fact. The third tactic: is to protect the principal. Another reason new investors fail is that they do not know how to safeguard their funds. First and foremost, you should never let your investment account take a loss. Second, always remember this first rule. In other words, if you want to join the ranks of successful investors, you should avoid making the same mistakes that others have made. So, the next question you may have is whether it is possible to invest without incurring a loss. Absolutely, and I'll show you how to make it happen. Before investing in a particular asset, every great investor must make a prediction, and if their prediction is correct and the value of their asset increases, they do not become greedy. Even if the value of their asset seems to go up forever, they don't keep it after they've reached their goals. They retain the profit and safeguard their initial investment. So if you're a new investor, you need to learn how to protect your capital by selling when your portfolio goes up. Never forget that market forecasts are inherently inaccurate. But if you protect your principal, you won't have to worry about how the market does, and you can make more money because of that. The fourth tactic: keep your greed at bay. Let's be honest, people are greedy. It may be difficult to accept, but it's the truth. There is nothing wrong with wanting more to oneself, as we all do. However, when it comes to investing, you must also be aware of how to restrain your greed. Some investors are always searching for hot stocks with high returns, but the reality is that most people lose money with such investment. For example, there are many stories about gold rushes in the past. However, the majority of these stories always come to the same conclusion. Many people will lose money in the mining industry, and only a few will become wealthy. Be fearful when others are greedy, and be greedy when others are fearful. This implies that you should not allow other people's greed to influence your investment decisions. When the stock price is high, only the first investors usually make a profit. Fear of missing out will likely lead you to purchase an overpriced stock, which could result in a capital loss if the stock crashes. Therefore, you must exercise extreme caution when investing, so you don't lose money thinking you've won the lottery. In addition, this does not imply that every hot stock or investment that promises high returns is a bad investment. However, you should be aware that if an investment sounds too good to be true, it probably is. Before making any decisions, you should do your research and learn as much as possible about a particular investment. Make sure you have a plan before you invest, and resist the urge to get greedy. The fifth tactic: profit from your losses. Despite the fact that some investors believe they have conducted sufficient research prior to investing, no one controls the market, and even the best investors do not always make accurate forecasts. Losses are an unavoidable part of the game, and the sooner you learn this, the better. As an investor, you must also use losses to your advantage. Learn from your mistakes and know that no one is in charge of the market. Even your best guesses could be wrong, and you can lose money. Furthermore, as an investor, you should not ignore your mistakes, but rather sit down and analyze them. Make a list of what you believe went wrong and possible solutions. Avoiding these errors in the future is insufficient. You must learn from them. For example, if you purchase a stock as a result of information you read on a forum from an unqualified financial advisor, instead of avoiding the forum altogether, the best option might be to carefully select and vet the post you plan to rely on your research. You can also use losses to help you diversify your portfolio. It is not sufficient to invest in multiple companies. If you want to diversify your portfolio, you should avoid investing in companies that operate in the same industry as one another, like Apple and Microsoft. So you could invest in a tech company and a transportation company. For example, to spread out your risk, again, your chances of success can be increased by learning from those who have already achieved the results you seek. The sixth tactic. Never. You must tell yourself, if only. Did you miss Amazon's initial public offering when one share was worth $18? Many other investors did, too. Or perhaps you sold your stock too soon, like the person who sold his 10% stake in Apple for $800. No matter how thoroughly you research, there will be times when you will make decisions that will make you say, if only I had purchased more of these stocks sooner. If only I hadn't sold so quickly. If only I had been more patient when you didn't have to waste your time wondering what ifs. What would you do if you bought the stock and the company went bankrupt within a few years? What if you didn't sell the shares and they lost value later? So, as you can see, it's pointless to waste time lamenting missed opportunities. Instead, think about what you already have and how you can improve your investment strategy going forward. Remember that it's fine to pass up a seemingly great investment opportunity. If you don't believe in a company, it's unlikely to be a good investment for you. Who knows? As long as there is a market, there will always be more IPOs no matter how much money could be made. You might strike it rich and purchase the next Amazon or Tesla. Seventh tactic. Recognize that investing entails dips. If you've ever looked at a stock market chart, you'll notice that there are reds and greens. Most investors like the greens because it means they'll make money, while they hate the reds because no one likes to lose money. But you can't always make money without having losses. The last psychological tactic you need to know from this video is that dips are a normal part of investing. Stock market crashes have occurred throughout history. However, it is important to note that investors who did not sell during these periods eventually recovered their losses and made a profit. Experienced investors know that a drop in the market gives them a chance to buy more stocks at a lower price. If you don't want to lose money, don't sell your stocks when the market drops. For instance, if you purchase a stock for $100 and sell it for $85 during a downturn, you have lost money. However, if you hold on to it long enough, you may eventually make a profit as the stock's value recovers and begins to grow. And it's yet another video that will assist us in being more educational. Are you interested in gaining more knowledge? Just make sure to give it a like. And if you enjoyed it, please subscribe to our channel. Hope to see you in the next one. Thanks!